Let's be honest for a second. For a lot of us, investing can feel, well, a little like being asked to navigate the Titanic through an ice field. At night, without a map. You know that feeling, right? There's a ton of anxiety, so much conflicting information, and this very real fear of hitting that one big iceberg that sinks your entire portfolio. But what if you had a plan? What if you had a structured, repeatable framework that could act as your radar, your rudder, and your lifeboat? Well, that's exactly what we're going to break down today. The 4 pillars that can help turn investing from a game of chance into a deliberate, thought-out strategy.
All right, so here's our game plan. We're going to start with the absolute foundation, the investor's mindset. From there, we'll build out our framework, one piece at a time, with the 4 key pillars: fundamental analysis, then technical analysis, cash flow strategies, and finally, risk management. And at the end, we'll see how it all locks together to create one cohesive system. Sound good? Let's dive in.
Okay, before we even dream of looking at a stock chart or reading an economic report, we have to start right here, with the foundation. Because all the best strategies in the world are pretty much useless if you don't have the right mental framework to begin with. This first part is all about figuring out the why behind your actions, long before you get to the how. This quote, it really gets to the heart of a super common way of thinking about money. It's a mindset that's all about security through a job. It means you're relying on someone else, a company, the government, to take care of you. The focus is on getting a pay raise, a good retirement plan, and solid benefits. The whole perspective is built around earning an income to pay your bills, and honestly, a deep-seated fear of taking any real risks. And this is where you see the huge difference in thinking. It's a complete shift in perspective. Over on the left, you've got that traditional path. You trade your time for money in a job. But look at the right side. The focus shifts entirely to acquiring assets, things that actually generate income for you. This philosophy is all about prioritizing financial education and actively managing risk, not just trying to avoid it. The crucial pivot here is moving from working for money to having your money work for you. Okay, with our mindset set as the bedrock, we can now build up our very first pillar, fundamental analysis. I want you to think of this as being a detective. It's about doing the deep dive research into the underlying health of an investment. And that could be a single company or, as we're about to see, an entire country's economy. This pillar is all about answering one key question. What am I actually buying, and is it financially sound? A huge piece of this puzzle is understanding what's called sovereign fundamentals. This is the real big picture stuff, and it's based on a surprisingly simple formula. Demographics plus policy equals the future. Just think about it for a sec. Demographics, that's the people, an aging population like the baby boomers. Policy is what governments do in response, like creating programs such as Social Security and Medicare. The way those two things interact gives us a really powerful lens to help predict where the economy is headed. And this right here, this is a brilliant illustration of what happens when those fundamentals go off the rails. You see, economies, just like our own households, can follow a very predictable pattern into trouble. First up is insolvency. You're spending more money than you're bringing in. Simple as that. You can't pay your bills. So what's the next step? Borrowing. You start using credit cards or, in a country's case, issuing bonds just to cover the shortfall. And the final, really dangerous stage is default. The credit cards are maxed out, nobody will lend you any more money, and you just can't pay your debts. So, if an economy is starting to slide down that slippery slope toward default, what can actually be done about it? How do the people in charge try to steer the ship away from the iceberg? This question leads us right to the levers of power that central banks, like the U.S. Federal Reserve, have at their disposal. And here are some of the biggest levers they can pull. First, you've got the reserve requirement. That just dictates how much cash banks have to keep on hand. Then there's the federal funds rate, which is the interest rate banks charge each other for overnight loans. And finally, the big one you always hear about in the news, open market operations, which you probably know as quantitative easing or QE. This is basically the central bank printing money and injecting it into the system to get things moving. Just understanding these tools is absolutely key to our fundamental analysis. All right, so our first pillar, fundamental analysis, helps us figure out what to invest in. Now let's build our second pillar, technical analysis. And this one is all about answering the question of when. It's the study of price charts and market psychology to better time when you get in and when you get out. There's probably no better story to show the power of technical analysis than Enron. When their CEO just abruptly resigned, the stock took a big hit. Now, all the so-called experts on TV, the fundamental guys, were telling everyone, hey, this is a great buying opportunity. But if you actually looked at the chart, at the price action itself, it was telling a completely different story.
It was literally screaming that the ship was sinking. The chart was revealing a truth that the news headlines were totally missing.
So, what are these chart readers actually looking for? Well, one of the most basic but absolutely vital patterns is an uptrend. The formal definition is a series of higher swing highs and higher swing lows. But in simple terms, just imagine you're walking up a staircase. Each step you take up is a higher high, and each landing you pause on is a higher low. As long as that pattern keeps going, you know the momentum is positive. It's that simple.
I absolutely love this analogy because it makes a really complex idea so clear. Think about looking at a stock chart like you're watching an old episode of Seinfeld. Every single episode has these recurring themes, right? Jerry's dating life hits a wall, George gets himself into trouble at work, Kramer has some new bizarre scheme. They're recognizable patterns. Well, in the exact same way, charts have recurring patterns with funny names like head and shoulders or double top that technical analysts learn to spot as signals of where the price might go next. So far, we know what to look for and when to act. Our third pillar, cash flow strategies, is all about the how. How can we use our investments to actually generate an income stream instead of just sitting around hoping for a long-term capital gain? This is where cash flow strategies are a total game changer. A really key concept here is leverage. Now, in this context, we're not talking about going into debt. We're talking about using strategic tools, like stock options. So for example, instead of buying 100 shares of a stock, you could sell an option, which is kind of like selling someone the right to buy those shares from you at a set price. And for selling them that right, you get paid a premium right up front. That premium is instant cash flow. It's a way to generate income from assets you already own. But, and this is super important, you have to remember that leverage amplifies both your potential gains and your risks. To make this crystal clear, let's use a real estate analogy. You can have different goals, right? You could buy a house just to flip it for a one-time profit. That's a capital gain. Or you could buy that same house to rent it out for steady monthly income, and that is a cash flow strategy. A third goal is to hedge, which is basically like buying insurance on your house to protect it. This third pillar is all about that second goal, creating a reliable, consistent income stream from your assets. This brings us to our fourth and final pillar. And honestly, it's arguably the most important one of all, risk management. See, you can have the best analysis in the world, the cleverest strategy, but without this, it's all built on a foundation of sand. This is your safety net. It's your insurance policy. It's your plan for when things inevitably, and they will, go wrong. And this brings us back to the Titanic. This analogy perfectly illustrates the whole philosophy of risk management. Listen, you cannot control if the market crashes. You just can't. That's the iceberg. That's systemic risk. But what you have 100% control over is whether you get on that ship without a lifeboat. The Titanic isn't even a story of everyone as a way off, right? Your pre-planned exit strategy, that is your lifeboat. So, how do we build this lifeboat? We use a method called the 3 crystal balls. It means we plan for every possible future. The first crystal ball shows us plan A, the outcome we all want, the market goes up. But here's the crucial part. You have to define what success looks like before you even get in. What's your price target? At what point are you going to take your profits off the table and call it a win? Next up is the second crystal ball. What's our plan if the market goes down? This is plan B. This is your lifeboat. Before you invest a single dollar, you have to decide at what specific price point will you accept that you were wrong, get out of the trade, and limit your losses. You are in complete control of this decision. Think of it as your emergency hatch. And finally, the third crystal ball shows us plan C, the future nobody talks about, where the market just goes sideways. It doesn't go up, it doesn't go down, it just stagnates. What's your plan then? If you're using options, is time decay going to eat away at your position? You see, by having a plan for all 3 potential futures, up, down, and sideways, you can trade with confidence and dramatically reduce all that stress and emotional decision-making. So we've laid the foundation with our mindset, and we've built our 4 pillars. But here's the thing. They don't stand alone. They actually work together, supporting each other, to form a single, powerful, and integrated system for navigating the markets. This table sums it all up perfectly. Pillar 1, fundamental analysis. That answers the what. Is this a healthy investment? Pillar 2, technical analysis. Answers the when. When is the right time to make a move? Pillar 3, cash flow, answers the how. How can I actually use this asset to generate income? And finally, Pillar 4, risk management. It answers the most important question of all. How do I protect my capital? You can see how they flow logically, one right into the next, creating a complete process for making decisions. You know, using a four-pillar framework like this, it gives you control. It's the difference between being the captain of the ship with a map and a rudder versus just being a passenger hoping the ship somehow avoids all the ice. It allows you to navigate with purpose instead of just being tossed around by the waves of the market. And that brings us to the final question we really want to leave you with. Is your financial plan a ship with a rudder, or are you simply adrift?